Stop everything. Close the other tabs. Put the phone down, because what unfolded while you slept wasn't just another rally. It was a regime shift in the silver market, the kind of overnight move that only happens when real power steps onto the field. New York went to bed with silver near $75 an ounce after a strong close driven by crisis headlines and a safe haven bid. Western desks assumed they'd regroup at the open, defend the breakout, and manage the story. But they forgot the one rule that matters now: when New York sleeps, Shanghai wakes. And Shanghai didn't hesitate. The Asian session opened around $75 and climbed with a speed that made technical levels irrelevant. $76, $77, then straight into the high 70s. By the time Shanghai wrapped, silver was near $79, roughly $4 higher, in a single overnight window on volume that doesn't belong to retail traders. That kind of buying isn't a trade. It's a message. When billions chase a market this tight, the objective isn't profit on a chart, it's ounces, control, and supply. In markets like silver, where physical availability is the constraint, sovereign scale demand changes the rules instantly. Price discovery moves, the center of gravity moves, and paper leverage runs into the one wall it can't talk its way around delivery. If you don't understand that distinction, physical versus paper, you'll misread everything that comes next. The spread, the arbitrage, the vault drawdowns, and why the old smash, the price playbook starts to fail. Dates matter. Tuesday, January 6th, 2026, may be the day you look back on and say, that's when the market stopped pretending. If you're still with me, subscribe and drop a 1 in the comments. If you think this is noise, drop a 2. To understand why last night mattered so much, you have to stop thinking like a trader and start thinking like a system analyst. Markets don't break because of price moves alone. They break when incentives flip and participants realize the old defenses no longer work. That's exactly what unfolded during the Asian session. A $4 move in silver doesn't sound dramatic to people used to stocks or crypto, but silver is not built for that kind of velocity. It's a slow, supply-constrained market where annual global production is small relative to the leverage layered on top of it. When price moves that fast on that scale, it exposes structural weakness, especially when the buying isn't speculative. What stunned institutional desks wasn't just the price, it was the volume. This wasn't millions flowing in, it was billions. Order flow showed relentless mechanical buying with no concern for pullbacks, resistance levels, or overbought signals. That tells you everything. Algorithms weren't chasing momentum. Funds weren't front-running headlines. This was capital deployed with a mandate: acquire metal. And here's where the math becomes uncomfortable. When a market that produces only a few $1 billion worth of silver per year absorbs a similar amount of demand in a single session, equilibrium disappears. There is no price discovery in the traditional sense, only rationing. Price must rise until demand is forced out, and that process is neither smooth nor polite. This is why calling it speculation misses the point. Speculators care about entry and exit. Strategic buyers care about ownership. When ownership becomes the goal, volatility isn't a risk, it's a tool. Western markets are conditioned to believe liquidity will always appear, that paper claims can substitute for physical reality. Last night challenged that belief. It showed what happens when someone with scale decides the metal itself matters more than the contract that tied to it. And once that realization spreads, behavior changes fast. What happened next is the part most people missed, but it tells you everything about who is actually losing this battle. While price surged in Asia, Western bullion banks were watching in real time. Their overnight desks were active. Their risk systems were lighting up. They saw the same volume, the same vertical price action, the same relentless demand, and they made a choice. They stopped selling. For decades, the silver market followed a familiar script. Every rally was capped. Every breakout was faded. Futures contracts were dumped at key moments to suppress momentum and exhaust buyers. It worked because the opposition was fragmented retail traders, small funds, impatient capital that could be shaken out. Control came from leverage and coordination. But last night exposed the limits of that strategy. When the buyer doesn't flinch, doesn't pause, and doesn't care about price levels, selling becomes dangerous. Every contract sold is a promise. And promises become liabilities when the buyer is willing to stand for delivery. This is where the psychology flipped. Banks realized they weren't facing traders anymore. They were facing balance sheets measured in trillions backed by industrial demand and long-term planning. Shorting into that environment isn't defense, it's self-destruction. Losses began compounding immediately. Positions built at much lower prices moved deep underwater, not over months, but in hours. And more damaging than the financial hit was something harder to quantify, the loss of control. When sellers step aside, markets don't drift, they reprice. For years, New York dictated the silver price. Other markets followed. That hierarchy created confidence in paper benchmarks. But last night made one thing clear: when physical demand asserts itself elsewhere, the old center no longer holds. This wasn't panic, it was recognition. And once that recognition spreads, the behavior of every participant, from traders to exchanges, starts to change. When control slips, the first crack always appears in price alignment. That's exactly where the stress surfaced next. As Asia closed near 79, New York was still anchored to the prior session's reality. Two prices for the same metal separated by geography, and that gap is where systems start to fail. This is where arbitrage enters the story, not as theory, but as force. A $4 spread on silver isn't noise. On 1,000-ounce bars, it's thousands of dollars in near risk-free profit. And markets do not ignore risk-free profit for long. Capital floods toward it, fast, ruthless, and indifferent to consequences. Physical traders immediately understood the implication. If silver could be sourced in the West and delivered into higher-priced Asian markets, every available ounce became a target. Phones lit up, dealers were called, inventory was offered premiums that would have sounded absurd just weeks earlier. Logistics stopped being an obstacle and became an expense one that still left room for profit. This is how paper markets get exposed. Futures can settle in cash, but arbitrage demands metal. And metal, unlike contracts, is finite. Every bar that leaves a vault tightens the system further. Every shipment reinforces the message that price discovery has moved. What makes this dangerous isn't the speed, it's the feedback loop. Arbitrage drains inventory. Drained inventory increases scarcity. Scarcity widens spreads. Wider spreads accelerate arbitrage. Once that loop starts, it doesn't slow down on its own. It ends only when price rises enough to shut the door. This is why overnight events matter more than headlines. By the time most participants react, the metal has already moved. The gap has already been exploited, and the pressure has already shifted from screens to vaults. At this stage, the question isn't whether silver is volatile, it's whether the system built around paper pricing can withstand a sustained demand for physical settlement. And that question is about to get very uncomfortable. The real stress point isn't price, it's inventory. That's where theory meets reality and where confidence starts to fracture. As arbitrage accelerated, the pressure moved directly into the vault system that underpins the paper market. Numbers that once felt abstract suddenly mattered. Registered silver, the metal available for immediate delivery, doesn't exist in unlimited quantity. It never has. But as long as few people demanded it, the illusion of abundance held. That illusion began to break as inventories dropped sharply day after day, not from retail hoarding, but from institutional pull. Each withdrawal tightened the noose, because when registered inventory declines, every outstanding contract becomes more fragile. The exchange can operate with low coverage ratios as long as delivery requests stay manageable. But when confidence shifts, requests multiply and leverage turns from advantage into threat. This is where force majeure enters the conversation, not as a rumor, but as a contingency. If an exchange cannot meet delivery obligations, it doesn't negotiate, it settles. Contracts are converted to cash. And the moment that happens, the paper price loses its anchor to reality. Think about what that means. A market built on trust admits it doesn't have the underlying commodity. Price stops being discovery and becomes fiction. From that point forward, only physical transactions matter, and only the markets that can deliver metal set the price. This is why inventory data matters more than charts right now. It tells you whether the system is absorbing stress or bleeding out, and recent draws suggest something closer to the latter. The uncomfortable truth is this: markets can survive volatility, losses, even panic. What they cannot survive is a loss of credibility. Once participants believe delivery may not happen, behavior changes instantly and permanently. At that point, the question isn't how high the price can go, it's how fast trust can disappear. This is where most traders make their fatal mistake. They assume the old playbook will return. They expect a sharp sell-off, a coordinated wave of shorting, a familiar pattern that resets the board. After all, that's how silver has behaved for years. Smash the price, scare the longs, restore order. Except this time, that mechanism is broken. Here's why. Short selling only works when the seller controls supply, or at least believes supply can be sourced later. But when physical demand is dominant and delivery is being pulled forward, every short becomes a ticking clock. You're not just betting on price falling. You're betting on metal being available when someone asks for it. That's the trap. If large players attempt to reassert control by dumping futures, now they hand cheap contracts to buyers who are perfectly willing to stand for delivery. Price suppression becomes self-defeating. The more aggressive the shorting, the faster physical inventories disappear. This creates a no-win scenario. If shorts step back, price rises, and existing positions bleed. If they press harder, they accelerate the very shortage that threatens the system. Either path leads to higher prices and less control. This is why volatility will explode, not because the market is irrational, but because it's trapped between incompatible realities, paper leverage, and physical scarcity. Corrections will happen. Sharp ones. They always do, but understand what those drops represent. They are not reversals. They are stress releases, moments where weak hands are forced out and supply transfers to stronger ones. Volatility is not a malfunction. It is the mechanism of transfer. It moves assets from those who need certainty to those who can tolerate uncertainty, from leverage to ownership, from promises to possession. If you don't understand that distinction, the next pullback will feel like failure. If you do understand it, it will look like opportunity. At this stage, psychology becomes more important than price. This is where most participants lose, not because they're wrong about direction, but because they can't survive the journey. Straight-line moves create confidence. Violent corrections create doubt, and doubt is where positions are surrendered. Expect a sharp pullback. Not because the thesis is broken, but because markets need to breathe. A rapid rise from the low 70s into the high 70s, without pause, leaves clusters of stop-loss orders stacked beneath the surface. Those stops are visible. They are predictable, and they are targets. When liquidity thins, often during overnight sessions, the market can be pushed just far enough to trigger forced selling. A cascade follows. Price drops quickly. Headlines declare the rally over. Fear spreads. Positions are liquidated at the worst possible moment. But look at who benefits, not the sellers, the buyers. Strategic demand does not disappear on dips, it intensifies. Lower prices invite larger orders. What feels like collapse to one group feels like opportunity to another. This is the cycle that transfers ownership. It's why corrections in structural bull markets are so violent and so brief. They are not meant to last. They are meant to cleanse. Understanding this keeps you from reacting emotionally. It reframes volatility as confirmation rather than contradiction. If price were drifting calmly higher, supply would still be available. It's the chaos that signals scarcity. Most people will misinterpret the next correction as proof they were wrong. They will exit just before the next leg higher begins. That's not bad luck. It's design. The market doesn't reward conviction alone, it rewards patience under pressure. And this phase is where that pressure intensifies. To know whether this move is real, you don't watch opinions, you watch relationships. One of the most important is the ratio between gold and silver. It's not a prediction tool, it's a positioning gauge, a way to see where capital is leaning. In the early stages of silver bull markets, gold usually leads. Silver lags, then accelerates as confidence grows. When silver begins to outperform decisively, the ratio compresses. That compression is not random. It reflects a shift from safety, first positioning, into scarcity-driven speculation. Historically, major silver advances have pushed the ratio down toward 30-1, sometimes lower. Extreme peaks have gone further. Where the ratio sits now tells you something critical. This move is still early. Not early in price, but early in participation. That matters because manias don't begin quietly. They arrive with attention media coverage and emotional excess. None of that is present yet. Most investors aren't watching silver. Most institutions are still underweight. That's not what a top looks like. Look beyond metals and you see confirmation. Gold making new highs signals monetary stress, not just industrial demand. Platinum's sudden strength suggests tightening supply across industrial inputs. Mining equities are reacting with leverage amplifying moves and advertising scarcity to anyone paying attention. These cross-currents tell a consistent story. This isn't a single market anomaly. It's a broader repricing of real assets relative to financial claims. Silver is simply the most sensitive instrument in that shift. When multiple indicators align, it doesn't guarantee outcomes, but it does reduce uncertainty. It tells you which side of the imbalance you're standing on. And right now, imbalance is the dominant feature of this market. Whenever a move feels this powerful, skepticism is healthy. Many have heard versions of this story before, calls for a silver breakout that never arrived, narratives that faded back into frustration. So the question is fair. Why is this time different? Because the driver is different. This isn't grassroots enthusiasm or speculative frenzy, it's strategic accumulation. History shows that when nation-level actors decide a resource is critical, markets adjust whether they're ready or not. Price becomes secondary to security of supply. We've seen this pattern across commodities. Once control shifts to buyers with patience and scale volatility increases, but direction becomes clearer. Supply chains tighten. Export policies harden. Paper markets struggle to keep up with physical reality. That's why the implications extend beyond silver. This is about a transition in how resources are valued. For decades, financialization allowed paper claims to dominate pricing. That works until someone insists on delivery. When that happens, leverage reverses. This is also why policy responses are limited. Increasing supply takes years, not weeks. Restricting exports carries political cost. Doing nothing accelerates the shift. None of the options are clean. As this dynamic unfolds, attention will follow. Media coverage will arrive late. Retail interest will surge near the most dangerous moments. By then, risk will be highest and opportunity lower. The early phase always feels uncomfortable because conviction is lonely. That's not a flaw, it's a filter. It ensures ownership consolidates before consensus forms. Understanding that difference between early discomfort and late euphoria may be the most valuable insight of this entire move. This is where we step back and translate analysis into action. Not trades, not predictions, but principles, because moments like this reward preparation more than precision. First, understand your exposure. Physical ownership is not the same as paper representation. One is possession, the other is a promise. In periods of calm, the difference feels academic. In periods of stress, it becomes decisive. If your strategy relies entirely on paper instruments, you are exposed to outcomes you don't control. Second, volatility is not your enemy unless you are over-leveraged. Leverage turns normal fluctuations into existential threats. Ownership absorbs volatility. It allows you to think in months and years instead of minutes and hours. That time horizon is your edge. Third, know your exit before emotion decides it for you. The goal is not to trade silver endlessly. The goal is to exchange it for something more stable when relative value peaks. Historically, that moment arrives when the gold-to-silver ratio compresses meaningfully. That is a strategy rooted in history, not hype. Fourth, ignore noise. Late-stage commentary will sound confident and urgent. Early warnings always sound extreme. The market doesn't announce transitions politely. It whispers first, then shouts. Most people only hear the shouting. Finally, recognize what this represents. This isn't just a metals rally. It's a signal about the direction of capital, the limits of paper systems, and the value of tangible assets in an uncertain world. Opportunities like this don't repeat often. They don't wait for consensus, and they don't reward hesitation. If this analysis helped you see the market more clearly, subscribe, share this with someone who needs to hear it, and let me know in the comments where you're positioned. The shift is already underway. The only remaining decision is whether you're watching it or participating in it.